digital credit is a platform. Digital credit is a platform on which to build on top of. So just as when Bitcoin came out, we saw payment rails, we saw companies and businesses that were starting to operate options, and we saw businesses being built on Bitcoin. Okay, now we've taken Bitcoin and we've put it in a corporate vehicle, and now it's being held as a treasury, and now digital credit instruments are being issued on top of it. Now, digital credit, businesses will be built on top of digital credit. There's opportunity to take that excess yield and over and above the risk-free rate and have an entire business model that fits within it. Whether that be, mortgages or insurance or stable coins or any other type of thing, there's opportunity to build with that digital credit foundation. And that's something that strategy is not going to compete with, or we're likely not going to compete with, where we're issuing the pure commoditized product and people can build on top of it.
Before we begin, let's make something clear. All views expressed in this podcast by me or my guest are purely our personal opinions. Nothing we say should be treated as a recommendation or an inducement to make any specific investment or to follow any particular strategy. This podcast is for informational and educational purposes only. It does not constitute financial, investment, legal, or tax advice. Before making financial decisions, you should do your own research and consult with a qualified professional advisor.
Welcome to a new episode of the Digital Credit Frontier. Today, I'm joined by Jeff Walton. He's the Chief Risk Officer at Strive, the CEO of True North, and he has a background in reinsurance. Welcome, Jeff.
Thank you. Thanks for having me. The Digital Credit Frontier. We're at the front here.
Yes. So really looking forward to our conversation. I met you in Amsterdam during the Bitcoin conference. We were on the same panel. I was the moderator. And you really, a lot of people inspired me to talk about Bitcoin and to talk about this topic, but also you've been an inspiration for me. And I don't know, so I just want to thank you for that. And I have so much questions. So I'm looking forward to explore all those topics with you.
Absolutely. Everybody needs to be talking about this. This is an enormous story. There's room for many people to be talking about this topic, digital credit, how they see it, how it applies to different industries and different businesses, and how this can be used on a personal level and a corporate level, and it will permeate everywhere. So I'm glad you're talking about it. It's good.
Yeah. All right. So, but I do want to say that I also need to be skeptical. And I need to ask the right question, because this is also for me the opportunity to ask a lot of people their opinions, but also try to figure out, are we on the right path? Can we improve where we can improve, and what could that be? So I also want to explore some of the maybe the difficult conversations and the difficult parts of this topic. But I think you're the right guy to talk to. So. And I want to differentiate a bit from, because you had great episodes with Bram and with Danny, but here I want to go in depth. So don't hold back. Let's go for it.
Yeah.
So you just went to the Middle East, and I want to ask you, what was your experience there? And can you talk about, because I want to talk about Sailor too, because I think I feel like he's haunted or something. He's on fire. He's meeting everyone, everywhere.
Right.
I mean, it's insane.
Yeah. The Middle East was incredible. You were able to see a world where harder money exists, right?
Mm-hmm.
They've got liquid money with their oil reserves. And that has created, Abu Dhabi and Dubai and this amazing architectural, cultural hub and an icon of wealth and prosperity in a place that, looking on a map, probably shouldn't exist. Right? In the middle of the desert, you start to think about infrastructure, just just the fact that I turned on the faucet in my hotel and water came out blew me away, right? I'm in the desert. Where does this water come from? I haven't seen a river anywhere. I haven't seen a lake anywhere. How does this work? And so just some of those things were incredibly fascinating to me. The cleanliness of the city was incredible. I didn't see homeless people everywhere. And I'm sure they have their issues. I'm sure there's poverty that we don't necessarily see, but the general outlook from a lot of people was very positive. I was able to get around the city very easily. Spoke English everywhere, so I had no language barrier anywhere I went, and yeah, it was generally very enjoyable. And compared to going to other cities in, Europe or even the U.S., it was just a far different experience. And I look forward to going back there. And apparently, about 9 out of 10 people that live in like Abu Dhabi and Dubai are expats or immigrants. So there's a very big diversity of people from all over, but that feel comfortable living there and making money there and earning a living there. And there's incentive to live there. So yeah, it was quite lovely. Honestly, I look forward to going back. But the conversations that we're having there at Bitcoin MENA were pretty fascinating as well. Just understanding how the political and economic architecture of those countries are created, and just in the Middle East, and the incentive for them to adopt Bitcoin architecture within their countries is there, right? The oil in the ground will eventually run out. So how do you ensure that your country has global power and global reign for the next 100, 200 years? They're thinking about those things. So, and then the political architecture in that region is very fascinating too, because if they want to change something, they can make a decision very quickly, and policies can be updated and change happens immediately. Whereas in the United States, it may take 6 years in order for a single thing to change, because you go through the incredible layers of bureaucracy. And in a world that's moving very quickly and digitally, that speed is very important in how your society operates and improves.
Yeah. I mean, yeah, you're mentioning the US maybe taking 6 years, but I mean, I don't want to mention Europe. I mean,
Yeah.
we're much worse. I think
Yeah.
sometimes when I see, with your political system and with a president, that you can really make changes within like a term, and here in Europe it's way too complicated and too bureaucratic. But yeah, so what was your biggest takeaway from like on topic, like from the conversations or from the keynotes that were there?
Really, it's the development of the credit ecosystem and how that's building. And at the same time, there were images of Semler going around to different countries. And, he was in Bahrain, he was in Kuwait, he was in Abu Dhabi, and all over the place. And you know exactly why. He's out talking about Bitcoin, and he's talking about digital credit, and he's talking about how a country can build a monetary system on top of this digital credit that strategy and in our company have created. And strategies pioneered it. And the concept being that so Bitcoin is this volatile commodity, and what, the preferred equity, the digital credit instruments that have been created are taking this volatile commodity and reducing the volatility and creating a 5 to 10 volatility product. And then the idea is that if you have the ability to issue your own currency, you could take this credit product and back a money with zero volatility. And let's say you've got 80% of your assets in the credit instrument, then you've got 20% in money market, then you've got a 10% cash buffer. Then all of a sudden you can create a shock absorber to reduce the volatility even further to make a zero volatility product. And that's a fascinating concept. And who wouldn't want a 6% savings account, 6, 7, 8% savings account with zero volatility? the demand for that is enormous. And I think originally that the idea was that Stretch or any of these credit instruments might be able to get there to a zero volatility product. But I think the reality is it's going to take a while. It's going to take years in order for anything to get remotely close to that. So in order to do that, there's opportunity for banks and central banks, countries to issue this type of product in their location. So this concept of digital money is the biggest idea delivered by a country to their citizens, and that was it's kind of taking this concept of digital credit as collateral. Like Bitcoin's great collateral. Digital credit is almost even better collateral because it's over collateralized Bitcoin. And a more conservative institution like a country or a bank can take that more conservative product and build on top of it.
Yeah.
So it's really the expansion of this idea of building on top of digital credit.
Yeah, and it really fits into the idea that I had for this podcast, because I was, I needed a logo, and I thought that I'm gonna do like a capital stack, or like I'll use the microphone because it's a podcast, and I'm using the base in Bitcoin, and then there's capital, there's equity, and the companies, they issue the credit, and on top of it, I thought, yeah, then you get like in finance, in the future of finance. So we're building the future of finance, and I'm hearing this, and I'm like, yes, this is exactly what I'm imagining, what I'm picturing, and what I want to find out. Like, is this working? And where can we improve? So I love it. And yeah, so Sailor also bought 2 weeks, 10,000 BTC. I mean, those are huge numbers. Were you expecting this?
Yeah. So that's a good question. Yeah, the last couple of weeks they purchased around 20,000 Bitcoin. This was all raised with the common stock. For the most part, common stock equity is probably 90 to 95% with the common stock equity. And this is on the back of raising 1.44 billion in cash reserves to pay the perpetual preferred dividends into the future, right? It gives them about 21 months of coverage from the dividend obligation or the dividend liability. And somebody tapped me on the shoulder when I was in Abu Dhabi the first week that they bought 10,000 Bitcoin after raising cash, and it is like, hey, Strategy just bought 10,000 Bitcoin. I was like, what? that was a bit of a surprise. It was a bit of a shock. And then the last 2 weeks they bought about 21,000.
Yeah.
And the fascinating thing is the outside of the preferred equity raises, that was one of the biggest 2-week periods of capital raising on the common equity in 2025.
Yeah.
So it makes you wonder, was there a significantly positive response in the equity when they announced that they had the cash reserve, because people then began to have confidence in the underlying equity?
Yeah.
And are they monetizing? They're still monetizing the premium, right? There's been a reduction in the premium on the net asset value of the company. So they're able to raise additional capital, which again solidifies the credit quality of the underlying preferred equity. They're able to buy Bitcoin at a depressed price when pretty much everybody else has been out of the market. And so I was a bit surprised at the strength, but also not at the same time, because the common stock has traded $3 billion a day. It's been one of the top 20 publicly traded equities in terms of volume since like October 30th, 2024. So 15 months.
Yeah.
And that's a crazy statistic. You think about, you've got this company now that's valued, it's like 220th largest company by market cap, but it's still trading the top 20 trading volume. So it was just a fascinating dynamic here, that there's so much interest in the stock it makes you wonder, like, how is this designed? Who is trading the equity so much? Why are they trading so much?
Yeah.
Is it hedging? Are people hedging Bitcoin price action with strategy? Is the options market now become the biggest and most liquid hedge for hedging Bitcoin because it is effectively a levered pure expression of Bitcoin? Is it the preferred equity strategy that's interesting? Why is the volume so high?
Yeah.
And that's something that we've been trying to wrap our heads around as well.
Yeah. So I was also talking to Tycho Onnas this week, and he's head of Bitcoin strategy at the Dutch Treasury company. And he said also like about digital credit and building these credit instruments on Bitcoin by Strive and the strategy and MetaPlanet. And he said like people are questioning if this is real or if there's a real demand for these instruments. And he said like I feel like this is like a ETF, like a Bitcoin ETF 2.0 moment, because in the beginning a lot of people also doubted the amount of dollars which could flow in. And we've seen like the best performing ETF ever, and but yeah, we're talking about the common stock, of course. So, but that could be a reason that people are catching up on the ID. I wanted to ask you because I see a lot of people talking about the MNAV, and we have like 3 different ways to calculate MNAV. So I want to ask you like, because the current strategy's current MNAV, like basic shares is 0.87, the diluted is 0.96, and the enterprise and MNAV is 1.15. So people are asking on the internet, on X, like, are they now diluting? Is this what is the right MNAV to take and to So please, can you explain what the enterprise MNAV is and what you think is the best way to calculate this?
Yeah, in my opinion, you have to evaluate the debt and the notional preferred outstanding in some regard, whether it's in the numerator or the denominator. So, or whether you take the market cap plus the debt, or you take the value of the Bitcoin minus the debt. So you've got to take it into consideration on either side of that calculation. So truly, I think the enterprise value way is the most efficient way to look at it, because it backs out the notional debt and the preferred notional outstanding. So there's been a lot of focus on MNAV as a number, but in my opinion, the reality here is that they're adding more capital to the balance sheet, and if these transactions happen at a MNAV with enterprise value greater than 1, this is accretive to the credit quality of the entire system and of the entire design of the vehicle. So if they're adding more capital, that's increasing the credit quality of the credit instruments that they've got on the balance sheet. It's bolstering the total assets that they have on the balance sheet, the assets, or the amount of Bitcoin exposure that they have per share. The cash raise was slightly dilutive. However, there's opportunity cost of the dilution that occurred with the cash raise. So the fact that they raised cash put strategy in a better position to increase the Bitcoin exposure per share, because that gave them a higher credit quality in their ability to go sell the preferred instruments into the future. So I think a lot of people have been really laser focused on the wrong thing, and the short term view of these individual transactions, as opposed to zooming out and looking at the broader picture of what's happening in the entire environment. Like the fact that strategy now holds nearly 70,000 Bitcoin, right? 670,000 Bitcoin. Yeah. And they have the structure is in place. They have effectively the best capital structure in place in the entire equity market.
Yeah.
And the ability to leverage that into the future. If Bitcoin moves If Bitcoin moves down, they've got the ability to cover their dividend obligations for a very long time, until the year like 2060, 2070, something. At current Bitcoin prices, they could cover the dividend obligations until 2070 to 2100, something like that.
Yeah.
And if the Bitcoin price moves up, that ability to pay those dividends into the future increases, and their ability to leverage and bring more of the preferred equity in the door also increases.
Yeah. So I want to touch on that point that you mentioned about, with a strategy having that USD reserve, they increase their credit quality. And this is there was a question that I had for you on the panel, but we didn't have enough time. And this was like a personal, and I know that Strive also like basically was the first with the 1 year dividend reserve on SATA.
We beat them, and then they beat us.
And I was invited for a podcast episode in September by Pascal Heugli, and I said to him, like, it makes a lot of sense if you're on a Bitcoin standard and you have dollar liabilities to have like a strategic fiat reserve. Like if you're on a fiat standard, you need a strategic Bitcoin reserve to bail you out in the future. But if you are on a Bitcoin standard, you need a strategic fiat or a strategic liability reserve. And I think it's good to point out that because they have this was dilutive because they didn't bought Bitcoin and they diluted the common stock equity. But if because that reason the preferred equities trade up, and if they want to raise the same amount of capital, they have less dilution on the total shares of the preferred equity, and that also means in the future they have less future liability. So this is you take one hit, but like you point out, it's for the better in the future.
Yeah, the mathematics are better off for the common stock shareholder afterwards, once there's additional preferred equity that's raised, because your ability to go raise that additional capital via the preferreds is also increased. Your ability to tell that story externally has also gotten significantly better. So when they raise capital for the cash reserve, and just like when we raised capital and held the cash reserve, it did multiple things. So it improved their ability to communicate to ratings agencies. So S&P came back and they've reaffirmed Strategy's rating since they've raised the cash reserve. However, that will help in the conversations moving forward. So you've got the strategic view of the rating agencies. It also eliminated a significant FUD item in the entire market of how are you going to pay the dividends. It's like, well, we're going to ATM the common stock. And it's like, okay, well, they just went and ATM the common stock for 8.5 days during a holiday week, and they raised 2 years of their dividends. So it really just proved that the business model worked beforehand, but now they just have the cash in order to do that. And it provides a significant downside protection. So this fiat reserve, as you mentioned, is you live life on a Bitcoin standard, but have a fiat reserve because the world, for the most part, is still dominated in fiat. You don't want to be in a situation where you have to liquidate any Bitcoin in a down scenario when you don't want to. When you want to be able to hold and wait out volatility in the long run.
Yeah, absolutely. So, I want to dive into the MSCI, maybe like the proposal that treasury companies with more than 50% digital assets and on the balance sheet will be excluded from the MSCI. Strive wrote a letter. I think the whole community now get up, like Bitcoin for Corporation Strategy. What do you think? Because I think that's on the 15th of January they will make a decision. What is the chatter? Do you know which way it would go?
Yeah, I think that. So yes, there's a letter from MSCI that's trying to exclude companies from the MSCI global indices that have greater than 50% of their assets held in digital assets. I think there was a list of about 100 different companies. And so far now, our company Strive, we put out a letter. Bitcoin for Corporations has put out a letter, and they're signing signatures. Strategy has put out a letter that is available on their website. I think they're accepting signatures as well. And then investors are reaching out to MSCI saying this is a bad idea. This is bad for investors. Investors should have the flexibility to opt in or opt out of this and remove that decision making, right? Passive investing shouldn't be making decisions like this. They can give options to opt in or opt out of whether you want this exposure to companies that are holding digital assets or not. But it seems arbitrary to exclude these companies because they're considering them as funds, when in reality these companies are they're operating companies. They have operating businesses, and they are leveraging their treasury just as any other company on the planet would be, whether it be oil or real estate or fiat dollars, cash, etc. All companies have a treasury. All companies manage their treasury. Most companies today in the United States, they don't want to hold cash, fiat dollars. So the treasury management teams are incredibly small at these companies because they give all of the capital back to their shareholders via dividends or via share buybacks. So this is not common in the existing landscape for like most companies to have a aggressive treasury strategy. But the fact that these capital assets exist now that are liquid and more efficient, it's a more efficient way to store your value. There's now an alternative to issuing dividends or doing stock buybacks. You can now buy Bitcoin, which is I think Strategy's dubbed this the most efficient acquisition target. It's like acquiring a company at 1x PE, right? Bitcoin doesn't trade at a multiple. You can always buy it at 1x PE. And that's effectively what these companies are doing. So they're leveraging their balance sheet to buy more of, acquire more of this asset. If MSCI or any other index provider were to take this stance with any other asset, oil, real estate, any other commodity, soybeans, wheat, whatever, this would be a ludicrous statement to make. And the fact that it's with digital assets is very arbitrary. And one of the most interesting and funny things is that if you actually look at MSCI, the company itself, 54% of the assets on their balance sheet are goodwill. Like it's nothing. It's an intangible asset. You can't sell goodwill. Goodwill isn't liquid. And the digital assets are highly liquid. Bitcoin trades $60 billion a day. That's a highly liquid asset. And the disconnect between what's actually occurring and what these companies are seeing and how they're treating it is very large. In terms of how this goes, I'm not going to hold my breath. I think that traditional finance is still significantly behind, despite how many people are talking about this stuff and where we think the world is moving. I think the reality is that there's a lot of learning that the traditional financial market needs to do. I think there's a significant amount of pressure from investors in Strategy, investors in other companies that are focused here. However, I think the likelihood that they revert on that change in policy is pretty low. So we'll see how it goes. If you haven't signed the petitions from Bitcoin for Corporations or Strategy website yet, go do it. And I think every bit helps just to make noise about this. But yeah, I'm not going to hold my breath.
No. So if I summarize the late statement, then you would think it's more likely, so it's above 50% that they will continue with this exclusion.
I think
Or-
it's a toss up. Yeah, I think it's
Yeah,
I think it's
okay.
50-50 right now, probably. Yeah.
All right. So I want to dive into the price action of the credit instruments lately. Are you surprised? Are they holding up better than you thought? Would you thought they would perform even better than they do? What are your thoughts?
Yeah. So there's a few things that I've been watching, and I've got them up on my screen here right now as well. So I've been watching these very closely. I think they've held up incredibly well based on how the price of Bitcoin's gone straight down from 126K down to where it's at today. What's 88,000. And these instruments have held up incredibly well. There was one period where I think STRC, after it paid out a dividend, the price dropped. It went from 100 down to, I don't know, 92 or something like that. And it's since worked its way back up, and it's now at 98.6. So you think about the duration of holding this instrument, and oh yeah, perfect. You got the screens up here. This is great. Yeah. So I think that you think about the duration of holding these instruments, and people have complained about the volatility of STRCs specifically. But if your time horizon is a month, like if you need this money in a month or 2 months, you wouldn't necessarily care that the volatility, that the price went from 100 down to 92 and back up to 98 today. Like that's happened within the course of a month. So I think what a lot of the retail community is having to learn is duration of holding. You could start to think of this as a 1 month type of T-bill, or like a 2 month type of T-bill, in order to get if you wanted to get your money back out from when you put your money in. So that's been interesting to watch. The volumes have been incredibly interesting as well, particularly our instrument SATA. The volume on that has been a fascinating thing to watch. It has, the preferred instrument itself has traded higher volume than some of the smaller to medium size Bitcoin treasury companies itself.
Oh wow.
Which is just a fascinating data point. We're trying to understand how the volume is comparing between all of these different instruments too. And yeah, ultimately I think what's happening here is this credit ecosystem is since it's been built and it's starting to evolve, people, traders, algorithms are starting to understand how these instruments move, and have the ability to move capital back and forth in between all of these different products. And that will continue to evolve. And whether that's arbitrage in dividends, or you think about STRC and SATA, so our two products, they've got X dividend dates that are opposite of each other. So they're both monthly instruments, and STRC is on I think it's on the 1st, and then SATA is on the 15th. And so one gets paid out, one has the X dividend date. So there's the ability for people to potentially roll those two instruments, depending on how they view the return of capital, or just gaming the dividend payments. Same with the quarterly preferred equity instruments. So you might have somebody that's holding the monthly instrument for 2 months, and then jump out of the monthly instrument to get the big quarterly dividend from any of these other ones, right? STRF or STRD. And so then they roll out of STRD and then roll back into the monthly one for the next 2 months. And then, so people are starting to figure out how to structure different portfolios based on generating cash yield off of Bitcoin in the Bitcoin ecosystem.
Yeah.
And that's fascinating. And then the question becomes, well, where did that capital come from? Is this new capital? Is this capital that was previously in MSTR? It's like a lot of this retail community has now moved over to having a bit of a cash portfolio. And who's interested in these things? How are they moving? And yeah, it's really fascinating. So to answer your question, they've performed very well compared to how I've thought they would perform. The fact that interest rates came down 25 basis points, these products didn't really move. It's interesting to see. It'll be interesting to see how that changes into the future, if as the federal funds interest rate changes, what is the immediate result? Is there an immediate result? Is it already priced in? are expectations already priced in? And do the credit spreads continue to expand? And you've got a good image on TradingView that shows the credit spread between all of the different instruments and how that's moving over time. Can you pull that one up as well?
Yeah. Let me pull it up. It's right here. So
Yeah, right. Right. Yeah. So you've got a, what is this? What's on the bottom? Investment grade preferreds paying 4.8. Is that what that is?
yes, sir.
Yeah. So investment grade preferreds are paying 4.8. And then you've got STRF is paying 9.29. So you could, I love this because you could really see how the spreads are changing relative to some of the investment grade preferreds that are out there, and like the high yield preferred fund. The high yield preferred fund is paying 6.59% interest. Yeah.
Here you can see the exact spreads.
Right. Yeah, and this is fascinating. This is super interesting. It'll be interesting to watch the correlation. Just in that period here, if you look back at STRK and STRF and compared to that high yield, it's interesting that they both moved very similarly. This is on the left-hand side of on the graph. There's a bump. How long ago is this? Yeah, back in April. I guess that was the tariff bump. It looked like everything moved in tandem there. That's interesting. Yeah, so it will be fascinating to see how these all move together. And even just in late November, it looked like all the preferreds moved. The credit spreads all increased at the same time.
Yeah. I mean, they're really moving in tandem, but the one like Stride, like they're also moving like you would expect they would move, because Stride is like moving more aggressively and Strive less. But also, like Strike was always below Strive, and then like since September they're almost like at the same effective yield, and now since the last couple of days Strike is even higher than Strive, which also is interesting.
Wow. Well, it's got a free call. It's got a free call option. Well, I guess the difference there is the fact that more instruments were put senior to Strike.
Yeah.
Right. So I think that makes sense too.
Yeah.
Like Stretch was put senior to Strike. And so was Stream. Stream was put senior to Strike. So I think that would make sense. The technical risk is moving in line with putting instruments more senior to it. Now, we're splitting hairs on the risk profile.
Yeah.
Right. It comes down to what is your probabilistic view of risk on those instruments actually.
I mean, that's a great point, because I had a question to you about Jeff Park, and because he said like Stride, he's been a fan of Stride because he says like, to me, Stride and Strive are basically the same risk, because like Bitcoin has to drop so much, and he said like, to me it's almost the same risk, and I'm getting like 2-3% more yield on Stride. So I think he's been pointing out that he's a fan of Stride, but that's like to your point too.
Yeah. So why? Right. The probabilistic scenario here. The interesting dynamic with Stride is that it's not cumulative. So the paper contract of Stride is what makes it a higher risk.
Yeah.
So just the fact that they could not pay the dividend and it doesn't accumulate is what makes it higher risk. So
sure,
there's always the probability, right?
Sure, but you get like 3% more each year. So like how they can miss.
Is that worth it?
Yeah, is that worth it? And now they've got that cash reserve. Like should that spread not be like a bit closer? So like
I think the probability that strategy elects to not pay the dividend is just so incredibly low, because the fact, if they did that, the credit spread would blow out. The price of Stride would drop so drastically.
Yeah.
But maybe not, because at that point, people would be rushing in the door to get an effective yield of, whatever that may be at a future point in time, if they were long and bullish the future of Bitcoin. But I think the likelihood that they actually act on the non-cumulative nature of Stride is incredibly low. So there is significant alpha there in the interest rate between the two. But you are taking on that theoretical risk. But again, it's coming down to your probabilistic view of Bitcoin going down into the future and Strategy not being able to raise additional capital on top, over and above their cash reserve. One thing that's fascinating is that the fact that Strategies raise the cash reserve, they may not ever use it. Right?
Yeah.
They may not ever use it.
Yeah.
And I wouldn't be surprised if they didn't use it, because it's just, if you started using it, then you'd probably want to be rebuilding it back up. You know what I mean?
Yeah, it's like in the US, you guys have the strategic petroleum reserve, and like that's for crises. Like that's not like not like the Biden administration didn't know that, but
right.
It's for crisis. So, and I think Fong also alluded to that they want to increase it to at least 24 months, and then keep it there, because they want just to have a reserve for at least 24 months.
Yeah, and if the reserve is higher, I wouldn't, if they went to 24 months, if they go from 21 months to 24 months to 36 months, they'd have the ability to weather an entire, near 3/4 of an entire 4-year Bitcoin cycle.
Yeah,
that's a lot.
Yeah,
and that would give them capacity to issue more perpetual preferred equity while keeping 21 months of coverage. So if they bumped it up to 24 months or 30 months or whatever that may be, then if they issued more without raising the cash reserve, that would inherently bring them back down to 24 months or 21 months or whatever that may be. So that I can see that being a strategy to go issue more of this stuff. If you had a buyer that wanted to buy $2 billion of this stuff, and they may say, well, I need you to have a 24-month cash reserve, then they might go raise the 30-month cash reserve and then bring in the $2 billion so that they still have the 24-month cash reserve. Something like that. I don't know. I think it's just an easier sell.
Yeah.
As opposed to saying like, hey, we have no cash, but we've got a ton of Bitcoin. And they're like, well, you publicly said you don't want to sell the Bitcoins. How are you going to do this? And it's just easier to communicate that to the traditional financial person.
Yeah. And to this point, Strategy bought like 20,000 Bitcoin the last 2 weeks. Is it also because they want to get their amplification back to 30, because now their stock price is dropping a bit, and then they're getting below or above the 30% amplification? And like, to your point, if they now like increase the amount of capital, they're back at 30, and then they have more capacity in the future to issue the credit instrument.
Right. Yeah. The amplification right now is at 27%, and that's with the debt at 8.2 billion. So the net leverage is around 11%. So 16% of that's coming from prefs. I think that they would feel comfortable getting that up higher than 27%. I think 30.
All right.
Yeah, like mathematically, especially if you have a cash reserve, theoretically, you could drive the amplification higher. Only if somebody's willing to buy more of that instrument at that point in time, just depending on the mathematics of the balance sheet. So really buying 20,000 Bitcoin at depressed prices, it boosts the credit quality, right? It boosts the amount of capital that you've got standing behind this. You're buying Bitcoin at a 30% discount from all-time highs. It's accretive to the balance sheet. One exercise that I like to think about is, if you're a shareholder of Strategy and the MNAV was just flat one, and they issued more shares at 1, and they bought more Bitcoin, but you had the same amount of shares, would you be happy? And for me, I would say yes. You have more Bitcoin, like you've now de-risked your balance sheet even more. Your balance sheet is more comfortable based on the amplification and the leverage you had in your balance sheet.
Yeah.
Yet when it's at a multiple, people, their heads explode and they think it's dilution for some reason. But I think it's a fair exercise to see, just even like focusing on one MNEF.
Yeah. I think, but like there is a point that you don't want it, because you buy strategy for amplified Bitcoin, so you don't want to get it too low. So maybe there's a point that you're saying, I don't think that's the right direction, but I get your point, and I think those exercises are great. So I want to dive into Strive. I have some Strive specific questions. I want to start out with the acquisition of Semler Scientific, and because, help me out, I don't know this, and maybe I think the audience maybe not also, like the Semler Scientific issued convertible debt, and as a company you're acquiring Semler Scientific, and you have preferreds on your capital stack. So, and convertible debt would come above the current preferred equity. Will that be the case? And if so, could this be like deal breakers for in the future, because you don't want to lower your credibility, your credit rating of those preferreds? Maybe that's more important than like acquiring a company, and maybe
we can talk through it.
Please.
Yeah, we can talk through it. So we are in definitive agreement to acquire Semler. There is a vote that is live and active right now. So if you're a Semler shareholder, please vote yes for the transaction to go through. That would be great. The transaction itself is a credit enhancing transaction. So we would be acquiring, I think it's around 5,000 plus 5,200-ish Bitcoin, 5,000-ish Bitcoin in that transaction. We would inherit the convertible bond. They also have a Coinbase loan, which is around $20 million. So convertible bonds are around $100 million. Last time it traded, I think it was sometime in August, and I think the price of it's around 80 part of 100. And then there's the Coinbase loan. And there are multiple ways to potentially retire a convertible bond. And that's theoretically there's a multitude of ways you can do this, whether that be buy back convertible bond in the open market, whether that be from Bitcoin sales or SATA issuance. And that could be, so there's the people that hold the convertible bonds. There could be negotiation tactics with them. Like these are companies that hold instruments. So you can talk to them about, hey, like you've got this and I want this, and can we come to a deal of what this may look like? And then there are companies that help facilitate those transactions. So it's possible, and it's likely. Our intention is to have the perpetual preferred only structure on our balance sheet moving forward, and we have considered a multitude of options should the transaction close. So I'm personally excited about the future of having an increased credit enhanced balance sheet, having a larger stack of Bitcoin that we could potentially leverage against. And I'm pretty confident in our ability to have a clean balance sheet moving forward.
Yeah, I can imagine. So Strive announced a small rate adjustment on SATA. So it's now 12.25. And this is basically because of your own guidelines, because it's traded below the $100, and then you basically have to increase the rate, right?
Yep. Yeah. So the stated range for SATA, what the intended range that we want the SATA to trade in between is $95 and $105. So our goal, our tools in order to do that is, if it's trading below $95, we can raise the interest rate to make it more attractive, so we can sell more of it to increase the liquidity profile, to bring it up into the stated range. And if it's trading above, we can either drop the rate or issue ATM, sell shares, etc., in order to get it into that tighter trading range. So this is the first month that we've issued the dividend. The dividend just came out. It got paid, I think, on the 15th, so just a few days ago, which was an exciting day. People that purchased the instrument got their first check from the dividend. And then because it's trading below our stated range, we have increased the dividend rate at par from 12% to 12.25%. Considering that it's trading below par, the effective yield is higher than the 12.25%. So it's helpful to take that into consideration. But I mean, our goal is to increase the liquidity profile and get it into the stating range, and we wanted to signal that.
Yeah, awesome. So we're almost heading to the 1 hour, but I really want to ask you something, and it also is something to like exchange thoughts, and maybe something that I bring from my background, because I worked 3 years in Bitcoin self-custody, and like we're talking about digital credit, we're talking about credit ratings, and a lot of that is financial. So we're looking at how large is the over collateralization of Bitcoin for those credit instruments. But I want to talk to you with you about like where can companies like Strive like differentiate from strategy, and I'm thinking in terms of like BlackRock and Bitwise. Like Bitwise are selling themselves as more crypto native, as more like on top and like the master of those assets. And if I'm thinking about credit ratings, can Strive, or like hypothetically, if they hold their own keys, because strategy is saying like what's better than Bitcoin, like more Bitcoin. Yeah, but what is better than more Bitcoin is like access to your Bitcoin, and also for your credit rating. And how cool is it? Like Bitwise is doing proof of reserves, and I'm also thinking about would it be great to have like if you own 1% of the hash rate, like we've got 144 blocks per day. If you own 1% of the hash rate, you basically say we mine 1 block a day, and in that block we can put a transaction of our own Bitcoin. So like if you have those Bitcoin to back up your credit instruments, you need to be able to access them, but you also need to be able to send them, and you need also be able to like create your block template for the mining. Because if others are creating block templates, maybe your transaction is not in there. And I'm also thinking about like, I don't want to get into you with the quantum resistant or the quantum computing, but if you as a company say, we have our Bitcoin at a quantum resistant address versus, let's say, a strategy who's holding Bitcoin like on a vulnerable address, then I'm wondering like what will be the impact on spreads on those credit instruments, because basically you're showing the world like we have those Bitcoin, we show the proof of reserve, these are our address, we sign messages that we still have ownership of the keys and we have ownership of the Bitcoin. How do you think about that, about differentiating between companies, and also differentiating on maybe credit rating in the sense of like these other risks?
Yeah, it's a good question. I think thus far that those concerns have yet to be a concern from the large capital that's coming in the door to purchase these particular instruments, particularly because at least in the US, all of the publicly traded companies are audited annually. So there's audits on whether they have access to their Bitcoin, what is the policy that's in place for your custody, what is your wallet infrastructure, who can control the wallets, how can the wallets move, who are your custodians, do you have diversified custodians, what is the policy in place for your company, are there layers of this type of transaction? And there's significant work in order to protect the Bitcoin on the back end. So there's multiple ways you could think about this. You could do that with a third party custodian and have that protection. You are taking counterparty risk. So that's one perspective. You could go the self-custody route, which is significantly more complex, but also potentially a little bit less transparent, because theoretically, then any of the credit buyers would have to go underwrite your individual policy of how you are managing your self-custody risk. So I think that would be more difficult and opaque than actually having a third-party counterparty that is fully auditable and trustworthy with other counterparties. So that's I think my perspective on, how that would impact the credit risk profile. And as of right now, we haven't had any demand from credit investors telling us not to use a third-party custodian. In fact, I think it would probably be the opposite. Like, hey, you're a small company with 30 employees. Like, it probably doesn't make sense for you to have a full self-custody model and holding your keys geographically diversified between your employees, or whatever that may be. Can that evolve? Absolutely. I think it can. But right now, there hasn't been significant demand. Now, quantum coming to play, I think that is something that we're not going to be a leader on. There will be leaders on that problem or that challenge in the market. And I've got multiple different perspectives on this. I'm still analyzing everything that's out in the market here at the moment. But when you think about quantum, and if there's a quantum solution, people will go to it. The third-party custodians will go to it. They'll be demanded to go to it. They will likely be leaders in addressing quantum risk, probably before any of the traditional financial banking institutions are addressing this quantum risk. And so I think that's kind of how I see it, and impacting the credit model. I think the traditional financial market is going to be behind on thinking about the relative credit risk here. And ultimately, you're getting paid what, a 500 basis point spread over and above like the high yield preferred equity products. Is that worth this credit profile? Yeah, I think probably. It's an interesting analysis, right?
Yeah.
So
yeah. So the thing is, what I'm thinking about is, because Strike, or it's not Strike, it's 21 Capital. They're Jack Mallers. They're throwing out their mempool open space website where you can track their Bitcoin and their on-chain addresses. And I'm just thinking through, how could you more diversify from others? It's hard for a company, it's almost impossible for a company like Strive to get bigger than a Strategy. So I'm also thinking about how can you maybe differentiate, and maybe, and I completely agree, because I read the S&P rating and they are for a third party custody. So basically you're hurting your own credit rating at this moment in time when you do the self custody. But we're Bitcoiners. And I'm also thinking what should we think it's the best way forward, or maybe you should have it on your roadmap, or express to the market that you're really want to move there once the rating agencies are ready for it. I think only expressing that view could differentiate the company from others.
Yeah. It's on our radar. I think at the moment, there's so much potential total addressable market that's interested in this credit product. I think that's a higher focus at the moment.
Yeah.
I agree with you that differentiating in this realm, particularly being at the forefront of Bitcoin tech, is important. But for us right now, the biggest differentiator between us and Strategy is our balance sheet structure and the architecture.
Yeah.
We don't have any convertible debt. We have 0 term maturities on our balance sheet. We just have a perpetual preferred equity model, and we only have one. So if you like the Strategy model, we have just a more simple version of the Strategy model with no debt. So that's how do we differentiate? And that alone, we have the model in the vehicle structure that strategy wants by the year 2029. And we have it today with 30% amplification, 31% amplification, whatever the number is today. But that's interesting. So if you're interested in amplified Bitcoin and you're interested in digital credit, okay, well, we have an amplified Bitcoin exposure profile that's different than Strategy's amplified Bitcoin exposure profile. And it's purely driven by our amplification in the perpetual preferred equity SATA. And then we have the digital credit SATA, which is paying a higher yield. So that in itself is a differentiator between Stretch and the other instruments. But we have a different risk return profile than everything that Strategy provides. So obviously we're unlikely to compete in terms of size and scale, getting to 3, 4, 5% of the network that Strategy is getting to, right? That last week they bought a Strive worth of Bitcoin. So yeah. I think it's going to be a little difficult for us to get to that scale. Not saying that we can't get to 100 or 200,000 Bitcoin in the next 10 years. Who knows exactly what that looks like? Our intention is to become the second largest issuer of digital credit in the market. And that is hopefully the efficiency and the simplicity of our story and our structure helps us to move at a fast pace, the pace at which Strategy would like to be moving at. But they're at a much larger scale. So it's harder to move a $60 billion value company than a $700 million value company.
All right. Thank you. So Jeff, is there something that I didn't ask that you really want to point out here?
Nothing that you didn't ask. I think you asked great questions. I think one of the largest takeaways for me at the moment is that digital credit is a platform. Digital credit is a platform on which to build on top of. So just as when Bitcoin came out, we saw payment rails, we saw companies and businesses that were starting to operate options, and we saw businesses being built on Bitcoin. Okay, now we've taken Bitcoin and we've put it in a corporate vehicle, and now it's being held as a treasury, and now digital credit instruments are being issued on top of it. Now, digital credit, businesses will be built on top of digital credit. There's opportunity to take that excess yield and over and above the risk-free rate and have an entire business model that fits within it, whether that be, mortgages or insurance or stable coins or any other type of thing. There's opportunity to build with that digital credit foundation. And that's something that Strategy is not going to compete with, or we're likely not going to compete with, where we're issuing the pure commoditized product and people can build on top of it.
All right.
That's going to take 4, 8, 12 years to materialize, just like the Bitcoin backed businesses took to materialize.
Okay, thank you. Thank you for your time. Jeff, where can people find you on the internet?
Yeah, you can find me on X. My X name is @punterjeff. I'm around at most of the conferences and looking to dip my toe in the water at some other finance conferences and insurance conferences here in the future. So please don't hesitate to come say hi. I will also travel globally in 2026. So yeah, look forward to meeting all of you.
All right. So it was a really pleasure to talk with you. You bring a ton of knowledge, and I had a blast, and thank you again.
Absolutely. Thanks for having me. See ya.
All right. Bye-bye.